What is going on, you guys, and welcome back to another video. If you are new to the channel here, my name is Brandon. What do you guys think of the new intro music? Typically every year I do change it up, just spice things up a little bit, just for my own sake and for fun. You guys can let me know whether you like it down below. I probably will do some testing over the coming videos, so yeah, maybe more coming. I hope you guys are as excited as I am to tackle 2022. 2021, in my opinion, was a bit of a weird year. Again, another weird year. And I don't know about you guys, but I'm kind of hoping in a sense that this Omicron virus kind of gets out there and does its thing in a non-damaging way. And it's more or less just like a, fast spreading cold, and then we can kind of get past this. That's kind of what I'm hoping for, guys. Nevertheless, I hope everyone's staying safe. I hope everybody's staying home when they can. But we're going to be starting this year off with a banger. 5 stocks to buy in 2022. I put this list together actually to go from more or less the conservative and safer picks and working our way up to the more aggressive picks as we get deeper in the video. And of course, with each of these stocks, I'm going to tell you guys a bit of the research that went in behind my decision process. Let's get on into the video, guys. Give this one a thumbs up, but let's start with a Canadian selection, and it is the stock Alimentation Couche-Tard. The ticker that you're looking at is ATD.B.TO. This is a stock that our followers know I just started buying in 2021, but it is one that I see myself holding in my portfolio for years to come. For those not familiar with the company, this is of course the convenience store chain that can be found pretty much across the globe. They're found here in Canada from coast to coast. They're in 47 states down in the United States. Many parts of Canada, you're actually going to see them branded as Couche-Tard. Pretty much everywhere else, you will see them under the brand Circle K, the less French type of store they have. They actually have a huge international presence, so areas like Europe, areas like Asia, they have actually thousands of stores across the globe. This is the stock that comes in first on our list today because it's really probably going to be the most generally accepted stock of the list today, and one that I think would really suit a lot of people's needs. Again, not the craziest stock when you think to the convenience store sector. Very, very reliable, very, very much a staple sector, especially when you think to products there. A lot of people overlook things like cigarettes. I know that's not everyone's favorite thing out there, but in reality, when you think about the convenience stores, you think about cigarettes, snacks, these are actually some very, very key drivers for them. This company as well does like fuel as well than just snacks. We're actually going to talk about that in just a second. But why I really like this stock in particular is we will be focusing in on the dividend. And today the dividend is not very big at all, but Couche-Tard is a stock that I would consider a growth stock with a very high opportunity to grow the dividend as well. As of today, the dividend they pay is only 11 cents per quarter. These are Canadian dollars, by the way. As you'll see, the yield is about 1.7, 1.8%, really nothing special. However, they pay out a fraction of their earnings. In fact, it's about 10%, just less than 10, actually right about just at 10, which to me signifies there is a ton of room for growth. When you factor in that this is a company that's earnings are growing steadily year on year. Just in the recent year, they pulled in $2.7 billion. These are USD, so we are kind of bouncing back. Actually, if we take a look at the estimates for the next year, slower next year. However, over the next 5 years, they're expected to grow these earnings at about 6% per annum. And that's a great, reliable rate. Nothing crazy, but also not too bad at all. In fact, looking back over the past 6 years, they've grown this dividend from 11 cents per year all the way up to 34. And again, these are in US dollars, but don't be surprised one day down the road, maybe 5 years out, 10 years out, a decade out, you look at the stock and they do pay a very attractive dividend. And of course, the investors that were there as they were increasing and ramping up those dividends, they will really be benefiting the most. Not to mention that it's a stock that's done well from a share price perspective as well. The second reason that I like Couche-Tard is actually revolving around their electric vehicle charging stations, or their network that they're expanding and growing. A question that we get so commonly in the modern day is, how can I play this EV space? It's clearly a shift that we're going through. This is clearly something that I want to take part of. And for me, rather than going out and buying a stock like a Tesla or a Rivian or a NIO, one of the car developers, not that you can't do well like that, and clearly a lot of people have, but often when you're looking at those types of hyped stocks, the very exciting producers, in my opinion, you're paying such a high price tag for them. They do trade at very, very high multiples. Buying a company like Couche-Tard is almost an indirect way of playing the space. And over the past number of years, they've been developing and essentially rolling out these EV charging stations across North America. Actually, they even just partnered with a company called Ionity, and that's going to expand their high-power charging stations across Europe. I'll toggle over to an article that I found by The Motley Fool. And although I don't often agree with the Motley Fool, they tend to be very contradictory with their articles. This is one that I do personally agree on. One TSX stock that is a cheaper way to play the EV space. And with the stock trading at a price to earnings multiple of 17, this is of course a trailing PE that we're looking at. I think there's big potential for this stock, not just in that aspect, but it's cool that you're getting exposure to that space. But in particular, I really love the fact that there's a growing dividend, or there's at least an opportunity for this dividend to ramp up over the years. Stock number 2 for our list today going into 2022, it's the company Lockheed Martin, ticker LMT, trading today at about $355 USD. So we are bouncing over to a US stock. They have a great dividend that they're paying today at 3.15%. Since about 2020, the stock has been on a downtrend, and I'm very much liking the area that the stock is trading in now. Trading at a PE of 16, this is actually a very attractive time for me to be looking at this stock. And Lockheed Martin, for those not familiar, is of course the largest defense contractor in the world. This is the company behind some of the most popular fighter jets, such as the F-35. Why I like this stock in particular, I've covered on the channel multiple times, but there's really 2 reasons that stick out to me. One being, I love the fact that within this business, they're very, very well diverse in terms of their revenue mix, in terms of the way they generate income. This company actually breaks down into 4 major segments. I'll put them up on the screen for you guys just so you're familiar. It's the aeronautics segment, it's the missiles and fire control, they have their rotary systems, and they have an area devoted to space systems. We do see by this pie chart breakdown that the aeronautics, or their planes essentially we can look at, is the largest driver of revenue, but still a very diverse mix, with 18% of this driven from the space segment. And we're hearing more and more about the importance of this new area. And really, you got people going up to space. You know, we're sending up all these famous people. We have it as this new tourist destination where people are going to go out and travel to space, essentially. And I know we really are just kind of at the forefront here, but it reminds me very similarly to how people want to approach the EV market. Again, rather than going in and directly investing in a company like Virgin Galactic, this is a company I got so many questions on over the years. And yeah, I mean, for those holding Virgin Galactic, sucks for you. To me, I asked the question, why not play this space by going with a proven business, with a company that is generating, actually in the previous year, $66 billion in revenue. Their margins have been expanding. Their earnings per share is growing year by year. You know, it's not the exact same. You can't make it comparable to Virgin Galactic because this company focuses more on things like satellites. They do like weather tracking up there and actually some sort of defense mechanisms in space, but they have partnerships with NASA. It's just a more reliable way of doing it. And to me, it's like, yeah, you can partake in this exciting area without taking on the risk of going all in on a new SPAC company. Again, that's just more or less my opinion. The second reason that I really like Lockheed Martin is that the way that this company operates its business, by nature, they are dealing with very, very long-term contracts. It provides a lot of predictability for these businesses. This company is constantly winning contracts from, let's say, the government that will essentially drive billions and billions of dollars over the coming years. In many cases, these contracts are expanding out, 2, 5, 10 years plus. It's not uncommon to have a contract that will last multiple decades. And that's why if you look at a company's backlog or their order backlog with Lockheed Martin, they have $135 billion in essentially orders coming in the pipeline, in the backlog is what we call it. And to me, this is a business model that gives me a lot of certainty about the future. Again, tag that on with the fact that they're so well diverse. I know you're going to get the naysayers that say, well, oh, it's so dependent on the government, which in a sense is true. Very, very dependent on the budget that's going out. It is true, but again, I think that is in a sense thinking short term. This is a stock that I think is going to reward investors over the long term. Again, paying a 3.15% dividend and trading at a PE of 16. This is a stock that I'm personally going to be continuing to build up in my portfolio going into 2022. Now, before we move on into our next stock, I will take a moment and ask you guys, what are the stocks that you guys are looking at for 2022? You can leave them down in the comment section below with either a top stock that you're looking at, maybe 3, maybe 5. I'm very curious to kind of see how the sentiment has shifted over the past year, especially seeing a little bit of volatility. Don't hesitate to leave a comment down in the comment section below. As well, I will remind you guys that if you are someone that's looking to learn more about the stock market, or maybe you're just a beginner and you need help getting started, we do offer courses and training through our academy. We work with over 1,000 people all across the country, Canadians specifically, teaching them how to go through that entire process. So that's that first link down below. But let's move on into stock number 3. It's a Canadian stock. I must say, don't sleep on this stock, all right? It might be a bit of a sleeper pick, if you catch my drift. It is the company Sleep Country Canada, ticker ZZZ.TO. I'm a big fan of that ticker personally. They pay a dividend of 2.1%, and I will point this out, very, very small company, $1.36 billion market cap. And I actually have to give a shout out to one of our students who brought the stock to my attention. To be honest, I think a lot of people were like me, being that this stock never ever crossed their radar. But I did a little bit of digging, and if you're looking for more of an exciting stock, and again, this is kind of ramping up the risk scale for this video, Sleep Country may be it. Sleep Country is, of course, the mattress retailer. They have actually over 280 stores across the country. Their revenue, just to take a look in terms of size, just shy of 900 million. So we're talking millions here, no longer billions. But this growth comes from their organic growth as well as acquisitions we're going to talk about in a second. 88 million of that hitting the bottom line. And I would say a very fair balance sheet. They do have a current ratio below 1, which is maybe not ideal for some. That said, this is of course looking at 2020 year numbers. And I mean, 2020 was a bit of a chalk year in and of itself. They have significantly reduced the debt in year 2020, which was by 100 million. They did, however, just recently secure some debt for a new acquisition this year. Nevertheless, I would say the balance sheet is quite fair for a smaller company like this. You know, no glaring red flags. And one of the reasons why I personally like this stock is that over the past little while, they have made a ton of, in my opinion, smart acquisitions. Now, it is still a little bit early, maybe a little bit premature to say that, but they have been investing quite heavily in these more modern, more kind of hip types of brands and hip types of companies. I know that sounds like a silly thing, but actually to me, on a deeper level, it shows that this company is actually changing the way that they are doing business. And to give you guys a good few examples, just recently they acquired, or invested, I should say, a 25% stake in the company Sleep Out. This is a company that does these blackout blinds. Essentially, we could look at this as a complement to the mattress side of their business, but very cool company based out of Vancouver. They, of course, bought into Hush, and Hush blankets is probably what you've come across. They do sell mattresses as well, but they're into like weighted pillows, weighted blankets. Endy, for those that don't know, is now part of the Sleep Country umbrella. This is a company that delivers you mattresses in a box, and they will literally send you a king-size mattress in a box. They are actually, from what I hear, expanding into other areas like couches. And what's important to me about these acquisitions in particular is that these brands and these companies have done a very good job of building up their digital commerce sales, or building up their digital presence, the e-commerce side of things. And I don't know about you guys, maybe it's just me because I recently got a mattress, but I am just bombarded with the ND ads or with the Hush blanket ads. This is on YouTube, this is on Instagram, this is on Facebook. For those that are maybe in the younger demographic, or at least more in tune with technology, these companies have done a very good job of building up kind of like a social media brand in a sense. And isn't that quite fascinating that a big old, traditional retailer like Sleep Country is making that bold move to say, hey, we need to get into these spaces. We need to get into these digital channels. I mean, it is bold, but as they say, fortune favors the bold. So it's still early to kind of, assess whether that's going to be pan out well. But to me, I do like to see that. It's good, in my opinion. Again, that's why we do see a bit of the debt kind of creeping up in this current year. Nevertheless, still a way that a lot of companies do decide to expand and grow. The second thing that I like about the stock is revolving around the idea of monetizing via warranties. So extended warranties, things of that sorts. And again, it might just be a little bit biased because I was just in there and I personally got bombarded with options and these tag-ons or these tack-ons to say, do you want, the mattress protecting service, or, these things, this or that. And actually what a lot of these companies will do, not Sleep Country specific, but it is quite common in this space where, you know, the markup they make or the margin on the actual sale of the good, sometimes not the highest, but when they can charge these extended warranties and when they get people paying year after year after year for 10 years out or whatever the case is, that is a very, very profitable and a very, very high area and margin of business. So again, to kind of compile the two reasons why I like this stock, you have the high margin extended warranties plus the growing channel of delivering through e-commerce or through digital. Again, to me, it says this company is changing and kind of putting itself in the right direction. Of course, as a bonus, you are getting a little dividend. I say little. Today it's at 2.1%. This is actually low because the stock has done quite well as of recent. You know, this is a small company, so expect quite a bit of volatility. But if you're looking for a fun stock, one to kind of throw in the portfolio, maybe a smaller position, take a look at Sleep Country. It's a Canadian stock that I think gets a little bit underloved. Now, moving on to our final two stocks, and we are ramping up the risk scale. I mean, I guess we could say that. For maybe so many people out there, this is ramping up the risk scale. For me, it's actually kind of funny because this is actually not... It depends how you define risk. But our final two stocks for this video that I think are ones to look into for 2022, if it makes sense for you, it's the company Tencent and it's the company Alibaba. Today, Tencent is trading for under $60 per share. I'm just gonna keep this short and sweet, guys. I do see potential for this stock to double. And when I say double, I mean, I'm not the type to go out and say, you know, 10x this or that, and hey guys, buy the stock, this or that. I do, however, feel that Tencent, based on the numbers, based on the metrics that I look at, it is significantly undervalued. Now, taking a look at the share price, we clearly have seen a strong sell-off. It looks to me like we are starting to see a bottom, trying to find a little bit of a consolidation here. Again, maybe too early to tell, but for one of the largest companies in the world, a behemoth in the tech sector, a huge social media company, massive followings, massive video game presence. To me, Tencent is a stock that obviously I wish I would have, you know, held off on my own purchase. For those that know my background, I do own Tencent. I've owned it for since about 2016. Of course, I would have loved to have bought now, but that's just how it goes sometimes. And the reality is that if I hadn't invested in this stock and I'm looking for new ideas, this is one that I would definitely throw on the watch list. I can echo this very similarly with the stock Alibaba. Again, these are, of course, two big Chinese stocks, so factor that into your decision. But Alibaba today trading at $118, this stock actually is close to where it IPO'd at. However, look at the PE that we're looking at. A trailing PE of 16 in this market, to me, is just insane. It really, really is. And there's a reason why I left these two stocks in my account, in my tax-free account, when I did sell out to make a purchase of a home. I said, hey, I'm leaving these two stocks for a very, very good reason. And if you haven't already seen my videos where I've given my really thorough kind of background and logic and decision that's going in on my head as to why I think that these are good investments, I will link that up at the top for you guys to go check out. I'm not just going to reiterate myself, but those are two stocks that did make my list. Again, maybe higher up on the risk scale if that's... It's funny how you can define risk, right? Obviously, these stocks come with their fair amount of risk, but at the same time, trading at a price that they are today, I actually think that this is more of a surefire bet than a company like Sleep Country, if that makes sense to you guys. Again, kind of interesting how you can look at it that way. But those are my 5 stocks that I want to share with you guys today. These are ones that are going to be on my list. I've either added to these stocks or I very likely will be coming over the next little while. Sleep Country is the one that I'm just going to be watching on the watch list. However, the others are close on the trigger finger, if that's so to speak, I'm curious to hear what you guys think of my picks. I'm also curious, as I said, to hear what stocks are you guys watching. So take a moment and leave that down in the comment section below. If you guys enjoyed this video, please do drop a thumbs up and make sure you're subscribed. We are going to be pumping out the content, absolutely pumping it out. If you want more stocks to buy content, if you want more content here on the Canadian market, click the subscribe button and make sure you ring the bell for notifications. Again, as always, we do have our Investing Academy as that first link down in the description below. But as always, I thank you guys for watching. Happy New Year, and I'll see you in the next video.